What if the secret edge you've been searching for was right in front of you all along? In the aisles of your local supermarket, in your own workplace, or in the products and services you use daily. Hey guys, welcome to TradeInvestor. Today we are going to dive deep into one of my all-time favorite gems in financial space of books, which is One UP on Wall Street by Peter Lynch. The book that proves you don't have to be a Wall Street insider or a financial genius to discover tomorrow's big winners in the stock market. In this summary, we'll unpack every major lesson from Lynch's investing classic, rich in stories, data, and actionable strategies, guiding you chapter by chapter through the timeless wisdom that's empowered millions of ordinary investors to achieve extraordinary results. Introduction: Peter Lynch and the Power of the Ordinary Investor. Peter Lynch, legendary manager of the Fidelity Magellan Fund, achieved annualized returns of nearly 29% from 1977 to 1990, one of the greatest records ever. But Lynch insists his edge wasn't complex equations or privileged access. It was observation, research, and discipline. Anyone can achieve success in the stock market if they are willing to do the work and trust their own experience. Lynch's book is a passionate argument. Ordinary investors have the tools to beat the pros if they follow a few simple rules. Chapter 1: The Making of a Stock Picker. Lynch recounts his early journey. A caddy for wealthy investors, he noticed that the really rich usually got that way not from inheritances or high salaries, but from business and stock ownership. His first investments, made with curiosity and observation, laid the foundation for his philosophy. Individuals can spot great companies before Wall Street ever notices them. He introduces the book's key message: your everyday experiences can give you an information advantage. Don't fear the complexity. Great investments often hide in plain sight. Start with what you know and build expertise from there. Chapter 2: The Wall Street Myth. Who can really win? Lynch debunks the myth that only institutional investors or math geniuses can succeed. In fact, amateur investors enjoy significant advantages. They're not under pressure for quarterly results. They can think long-term and skip short-term noise. They're small enough to invest in the next Walmart or Starbucks before the institutions pile in. He shares how many of his best picks came from listening to his wife, watching his kids' choices, or noticing what was flying off store shelves. That's the power of being tuned into the real world, not locked in an ivory tower. Chapter 3: Preparing to Invest. Research beats rumors. Building wealth in the market starts with preparation, not hot tips. Lynch argues that successful investors avoid speculation. They rely on research and logic. Keep a notebook of companies around them. What businesses are thriving in their hometown? Which brands have raving customers? What problems are being solved? Spend as much time studying an investment as they would researching a new appliance or car. He firmly believes that most people fail at investing not due to lack of intelligence, but due to lack of process or discipline. Chapter 4: The 6 Categories of Stocks. Lynch's key contribution is his simple stock classification system, which helps investors set realistic expectations and better manage risk. The 6 categories are: slow growers, mature companies, stable but not expected to expand rapidly. Think established utilities or blue-chip firms. Stalwarts, large, stable companies still able to achieve moderate growth. Brands like Hindustan Unilever or Asian Paints in India. Fast growers, small, nimble, high-growth firms. Potential to multiply many times over if managed well. Cyclicals, businesses that surge and dip with the economy or commodity cycles, like auto, steel, or airlines. Turnarounds, troubled firms staging comebacks, where positive change can lead to outsized gains. Asset plays, companies undervalued for their hidden assets, real estate, patents, or subsidiaries. Lynch explains the importance of matching your expectations to the category. You can't expect a utility to double in a year, nor should you hold a turnaround through years of stagnation. Chapter 5. Spotting Opportunities. Invest in what you know. Lynch's most famous piece of advice. Start your search for stocks by noticing the products, services, and companies you encounter in daily life. If you love a new retail store, see it constantly busy, or everyone raves about a product, consider if the company is public and worth investigating further. This grassroots approach led Lynch to legendary picks like Dunkin', Donuts, and Haas. But he cautions, observation is only the beginning. The real work is research and analysis. Chapter 6. Doing the homework. How to research a stock. Lynch lays out the essential steps to vetting an investment. Review the financials. Analyze earnings growth, profit margins, debt levels, cash flow, and sales trends. Study management. Is leadership experienced, ethical, and aligned with shareholder interests? Understand the business. What does the company sell? Who are its customers? What's the competitive edge or moat? Check the valuation. Is the stock reasonably priced versus earnings, PE, sales, PS, or assets, PB? He emphasizes avoiding investments you don't understand and urges against diversification, over-diversifying without conviction. Chapter 7. The story behind the stock. Developing your thesis. Every stock needs a story. The clear, simple reason you believe it will flourish. Lynch advocates writing down your 1-minute elevator pitch for any company. What is the business and why will it grow? What are the critical risks to your thesis? What will make you sell the stock? Simple, testable stories keep you focused and prevent emotional knee-jerk reactions to market moves. Chapter 8. Not all growth is created equal. Lynch warns that explosive earnings can mask underlying issues. Check if high growth is sustainable, or if it's a flash in the pan. Be wary of companies expanding too quickly without the capital or infrastructure to support it, and those relying on frequent equity or debt raises. Fast growers can offer the biggest rewards, but require the most careful monitoring. A major insight. The best fast growers are often those that have just begun their expansion journey, not those already recognized as stars. Chapter 9. Economics, Cyclicals, and Predictability. Investing in cyclicals, like commodity companies or automakers, comes with unique risks. Lynch suggests watching industry cycles carefully. Buy when conditions are terrible, sell when the media is euphoric. Never get caught extrapolating high profits eternally forward. Cycles always turn. He provides checklists for monitoring inventory, pricing, and demand. For Indian investors, classic cyclicals include cement, metal, and auto sectors. Timing and patience are essential. Chapter 10. Turnarounds and Hidden Gems. Turnarounds are struggling companies with the potential for big gains if they right the ship, often overlooked by Wall Street. Analyze why the company stumbled. Is it fixable or a permanent decline? Key signs include new management, strategic refocus, or asset sales. Lynch often found his most successful turnarounds among companies everyone else had given up on. But beware, many turnarounds don't succeed. Diversifying and limiting exposure is key. Chapter 11. The Power of Assets, Asset Plays. Some companies are undervalued because the market ignores their assets, like land, patents, or stakes in other businesses. Lynch advises reading footnotes and annual reports to unearth these hidden values. Asset plays are often unglamorous, requiring patience for the market to realize their worth. Examples might include holding companies, real estate-rich businesses, or fast-growing subsidiaries buried in larger organizations. Chapter 12. The Importance of Patience and Long-Term Focus. One of Lynch's top themes. Success comes from holding great companies long enough for their value to be appreciated. He's famous for holding some stocks for years, riding out volatility and market panics. Most investors sell when stocks dip from impatience. Lynch advocates using price drops as buying opportunities if your thesis holds. He urges investors to focus on business progress, not daily stock price swings. Chapter 13. The Role of Institutions and Analyst Herding. Lynch highlights how professional managers often underperform because they do closet indexing, hugging benchmark weights to avoid short-term embarrassment, fall victim to groupthink, chasing the same trends everyone else does, must focus on short-term results to keep their jobs, unlike retail investors who can think in decades. Your edge? Ignore the herd. Trust research, not the media hype or Wall Street's flavor of the month. Chapter 14. Signs of a Good Investment. Peter Lynch's Checklist. Lynch provides a roadmap for evaluating any stock. Is the company growing and profitable? Does management own significant stock? Is debt under control? Are earnings predictable? Is the valuation attractive? What could go wrong? Write it down and think through the risks. He shares his 2-minute drill. If you can't explain in 2 minutes why you own a stock, you probably shouldn't. Chapter 15. Avoiding Danger, Red Flags and Common Mistakes. Lynch lists the danger signs that should warn off any potential investment. Sky-high valuations without clear growth paths. Companies with complex structures or opaque finances. Situations where management is selling lots of stock or diluting shares. Businesses in declining industries with one-off earnings bounces. He encourages staying humble, recognizing that even the best investors are wrong 40% of the time. Chapter 16. The Art of Selling. When to move on. Knowing when to sell is as important as picking a winner. Sell when the company's core story changes, not just because of short-term price drops. Lynch advises reviewing each holding annually, asking, would I buy today? Don't let gains or losses bias your decision. Stick to the plan. He notes, selling is not failure, but an active part of disciplined money management. Chapter 17. Investor Psychology, Winning the Mental Game. Lynch reflects on the major reason most investors underperform their own stocks. They can't stomach volatility or setbacks, so they sell at the worst possible times. His advice: accept that downturns and drawdowns are inevitable. Success comes to those who can stay the course and add to winners when others are panicking. Don't get greedy in bull runs, nor despondent in bear markets. Always judge by business fundamentals. Remember, a portfolio is built over years, not days. Chapter 18. Lessons from Lynch, Synthesizing the Philosophy. The final chapters summarize Lynch's timeless principles. Use your real-world knowledge to spot investable trends. Don't wait for Wall Street's approval. Do your homework, read, analyze, and write down your reasoning. Focus on great businesses with simple models, competent management, and reasonable prices. Be patient, let winners run, cut losers decisively. Trust your own process, adapt as you learn, stay humble and persistent. Conclusion: your roadmap to outperformance. One Upon Wall Street is a manifesto for ordinary investors to seize their edge, trust their experience, and commit to the hard work of research and discipline. Its lessons, grounded in decades of triumphs and mistakes, are as relevant in today's fast-moving digital markets as they were when Lynch first penned them. Ask yourself, what products do you love? Which companies do you believe in? And how can you use your insight to spot the next big winner? Are you ready to move from passive spectator to active stock picker, armed with process, patience, and Lynch's proven playbook? If you found this audiobook summary valuable, like, subscribe, and share your own Peter Lynch takeaways below. Which story, habit, or strategy will you use in your investing journey? Stay tuned to TradeInvestor for deep dive summaries, practical market wisdom, and your path to lasting financial independence. Remember, you don't need to be on Wall Street to win big. You just need to pay attention, do your homework, and invest with courage and common sense. See you in the markets.